Yes, ma'am. It started.
Yeah, okay.
Good afternoon, when all present here on behalf of Women Pediatrician Forum in this monthly webinar, which also happens to be 11th activity of our current executive. With due permission from our President, Dr. Sangita Lodha, ma'am, I am introducing this topic, today's topic. Shall I start, ma'am?
Yes.
As we all know, financial literacy refers to ability to understand and apply different financial skills effectively, including personal financial management, budgeting, and saving. Financial literacy makes individual become more self-sufficient so that financial stability can be accomplished. 5 basic principles of becoming financially literate are to earn, to spend, to save, to invest, borrow, and to protect. This education helps the individual to reach their goals by better understanding how to budget and save money. We can create plans that define expectations and choose a right path to achieve these goals. Key aspect of financial literacy includes knowing how to create a budget, plan for our retirement, management debt, and track personal spending. We, as women doctors, spend very less of our energy and wit for the financial planning and leave this important corner of our life to our husbands and other male members of our family to decide. As an intellectual professional, we must learn this knowledge through proper reading, listening, talking to financial experts for better management of money which we are earning. Keeping this idea in back of our mind, we WPF have planned today's session with 3 of the financial management gurus. Besides being medical professionals, they are also exemplary knowledge examples in financial planning for betterment of our future. To conduct today's session, we have our moderator, Dr. Meenakshi Verma. With this, I invite our President, Dr. Sangita Lodha, ma'am, for her welcome address.
Yeah. Very good afternoon to all respected dignitaries. I, Dr. Sangita Lodha, Chairperson, Women Pediatricians Forum. Welcome you all for today's webinar, Financial Literacy, which is need of hour. So I, without wasting time, hand over the mic and this platform to our moderator, Dr. Meenakshi Verma. Over to Dr. Meenakshi.
Let me introduce Dr. Meenakshi Verma first. Dr. Meenakshi is MD Pediatrics from prestigious institute PGI Chandigarh and has done PGP in Boston, PGPCH in 2021-22. At present, she is senior consultant pediatrician and adolescent health specialist at Sparsh Clinic, Jirakpur, Punjab, with having 20 years of post-MD experience. With this, now I hand over to Dr. Meenakshi Verma for further conduction of today's session. Dr. Meenakshi.
Thank you, Dr. Anuradha, and thank you, Dr. Sangita ma'am, for your kind words. And I'm feeling so blessed to have this opportunity to moderate this very incredible session. And it is out of our usual academics, finances, management of finances. Thank you to team WPF, Dr. Himabindu ma'am, Dr. Sangita ma'am, Dr. Anuradha, Dr. Elizabeth ma'am, Dr. Srilekha Joshi, Dr. Narmada Ashok. You all are so incredible. And I welcome you all to this session of today. Today's topic, as you know, is a bit different from our usual academics and something which we are never taught in schools, colleges, not in medical colleges, and that we have to learn by ourselves, but somehow we failed in that. Managing our finances is as important as managing our patients. But we have to have complete knowledge about this thing, which we are not having. How our hard-earned money has gone, how to spend it. That is very important to know. So, and also as women, we are dependent upon husbands, fathers, brothers for our hard-earned money. And I'm sure after listening to this session, we will definitely take the stakes in our hands. So with this, I welcome our first guest, Dr. Harisha Gopal, who will be educating us about selection of stocks to build long-term portfolio. Let me share screen for sir's.
Sir, I will share, madam.
Okay.
I will share because I have made certain changes.
I just want to introduce you, sir. Sir is Professor and HOD Department of Pediatrics, Dr. Patnam Mahinder Reddy Institute of Medical Sciences, Telangana. He is a senior guide of WealthCon and a financial enthusiast. So over to you, sir.
Good afternoon, all wonderful ladies. And I don't agree with this opinion that women give their money to husbands. Why? Because my wife doesn't give me. That is point number one. And point number two, I would like to give an information that in our WPI group, one of the women, I will not name her, she is earning the most out of all the including men. So you should be proud of women. So with that, today I will like to start with basics of stock investing. So my name is Dr. Harisha Gopal. I'm the HOD. So here I'll be covering under the following subheadings: why we have to do stock investing, which stock to invest, when to invest, how to invest, how much to invest. So I'll make this very simple because stock investing is at least a 6 months course, which I'll try to cover in few minutes. Okay. So first is which stocks. As you know, stocks means they are representation of a company. So companies are divided according to their capitalization into large caps, mid cap, and small cap. What does it mean is that the price into the number of stocks is the capitalization. So the large caps are the big players in the market. The mid cap are the mid players, and the small caps are the budding players in the market, to put it in a simple words. So in this, we can choose either a large cap, mid cap, and small cap based on a risk portfolio. Now, what is the procedure to select a stock? So we have to do something known as the three pillars. First is the fundamental analysis. Second is the valuation analysis. And third is the technical analysis. What is this fundamental analysis? It will tell you whether the stock is a good stock or the bad stock. What is this valuation analysis? It will tell you whether whichever stock you are buying is cheap or costly. What is this technical analysis? Tell you that whether it is the right time to buy or a wrong time to buy. So ideally, you should have a good company at a cheaper price and at the correct time to buy. So this is the ideal. Now, how to go about it? We will see. So we have a criteria. This is a WealthCon criteria where we use for stock selection. We have something known as the MPTDS criteria for large cap stocks and MD sport criteria for mid cap and small cap stocks. What is this criteria? We'll see in the further slides. Now, this MPTDS criteria is a criteria used to filter out good stocks from the bad stocks, especially in the large companies. So, we take certain parameters, that is market capitalization should be more than 10,000 crores, price should be uptrending, taxes paid should be more, dividend, I will tell you in this. For this, we need to use a website known as the screener. So I would like to share a screener for you. Okay, 1 minute. Sorry, madam. I'll just share a screen again. Okay. So we have to go to this website known as the screener. Here we can choose something known as a any company, whichever you think you have to do an analysis. Here I'm taking an example, Tata Consultancy Services. We are going to run a screen using this MPTDS valid stock or not. So the first one is market capitalization more than 10,000 or 10,000 crore or not. So if we use this screener, here we have something known as the market capitalization. So it is more than 10,000 crores. So the first filter is ticked. Okay. Then we come to the price. So we are using this website. Please note down this website. It is known as screener.in. Okay. So first we see the market capitalization. We don't want to invest in a small company which can close tomorrow. So we are investing in a market capitalization of more than 10,000 crore. So since it is fitting that criteria, we are going to the second thing, that is the price, MP. So we are going to select max, okay, and we are going to unselect volume. So here you can see that the price is in the uptrend. You can have little bit zigzag motions, okay, but overall from January 2006 to now, you can see that the price is always going up. So this is a sign of an healthy company, okay. Next will be taxes paid. So for the taxes paid, I am going to go to the cash flow system. Okay, here you can see I am going in the top, I am going to the cash flow system. Once I select this cash flow, then you will have this taxes, operating activity. You will have three things: cash from operating activity, investing and financial. The first one you select and you see this, there is something known as the direct taxes. Now what are these direct taxes? It is the taxes which are paid by the company to the government. So who will pay more taxes? When the person is earning more number of profit. So when whichever company is earning profit year by year, it starts paying more taxes. This cannot be lied or it cannot be manipulated. So why it is in minus? Because it is going away from the company to the government. So you can see that from minus 4,822, it has become minus 12,489. That means this is a 10-year data which we have, and every year the taxes paid are increasing. That means the profits are increasing. That means the company is paying more taxes. So that is a third criteria ticked. Then I come to the dividend paid. Dividend paid. What is this dividend? The company shares certain profits with the investors who invest in the stock. So I go to the last one and I see the dividends paid. So from minus 5,000, you can see that minus 5,000. Again, why minus? Because it is going away from the company to the investors. So from minus 5,000, every year on year, it is increasing to 25,000. So dividend is also ticked. Okay. Then comes sales. Okay. Last one is the sales. So sales should be increasing. For that, you have to come above. And here you can see in a March 2013, it was 62,000 crores and now it is 2,44,000 crores. So even sales is increasing year on year. This is a 10-year data which the screener gives. So again, once for all, I'll repeat as a summary. First, the market capitalization should be more than 10,000 crores. First criteria. Second thing, you select max and you see the price. Price should be always in the uptrend. Number three is the cash flows. You come to cash flows. Then number three is a taxes. That should also be increasing year on year in the last 10 years. That is MPT. Then we have dividends. That also should be increasing year on year. And last is the sales. Okay. So sales are also increasing year on year. So if you see, if you apply this criteria for any big company, if it fulfills this criteria, then it is a very good company. With eyes closed, you can invest in that stock. No need to do any further analysis for long term. Okay. So remember this website, it is a free website known as screener.in. Just apply this criteria. I will post the PDF also so that you can know what are the steps to do it, and it is very easy. Okay. So all good stocks will meet this criteria. Blindly you can go and invest without asking anybody. Okay. Next comes for the small cap funds. In addition to the market cap, we also see certain things known as the debt to equity ratio, sales growth ratio, profit growth. I think if I start going about it, it will confuse you. But just remember that the lower the debt, see why are we stressing on debt is a loan which is taken by the company. Lower the loan, the healthier is the company. That's why a debt is included. Sales and profit should be more and operating profit is more. So I will not delete upon this. But for a long-term investor, this criteria is more than enough. Now, since we have uh, made sure that which stock, that is by doing a fundamental analysis, we'll do a little valuation analysis. I am going to make it simpler by telling you a simple thing to know when it is cheap or not. So if you in the screener, if you come in the under this profit and loss statement, you can see 4 boxes are there. You can see 4 boxes are there. Say valuation, there are so many things like PE ratio, so many 10,000 variables. But I will like you to concentrate on these 4 boxes, especially the 2 middle boxes, compound profit and stock price. That means how much the company is providing the profits and how much is the stock prices. If you see this, the 10 years data, profit is 9%. Profit is 9%, but the stock price is 13%. So what do you understand? The profit, the company is giving less profit, but the stock price is rising abnormally. So it is a little overvalued company. It is a little overvalued company when the profit is less than the stock price. This is a rough estimate. I am not telling this is the only metric to use, but this is a very simple metric to use. I will show you one more undervalued company by taking ITC. ITC again, it is market cap more than 10,000. Price is on the upside, though there was a COVID dip. Okay, I will not go again. I will show you only this one. See here, profit is 9%, 10 years profit, and the stock price is only 7%. So this is an undervalued company. You can blindly go and invest in ITC even today. Okay. So it will definitely meet dividend criteria. It will definitely meet sales criteria. I'll just show you. Okay. So if I take, you may ask me, no sir, show me once. So if you can see minus 3,000 to 19,000. If I take taxes, okay, direct taxes minus 3,000 to 6,000. So all the criteria will be met. But I am telling you the valuation. Always the profit should be more than the stock price. Then only you can tell that it is little undervalued. So it is ideal to have a lesser stock price than the profit. Okay. So this is about the valuation. Now coming to technical analysis. Now how do you know when to enter? Okay, sir, you told good stock, you told it is cheaper, but is it the right time? When am I entering at the right time or not? So for that technical analysis, I'm going to use there's some website known as the tradingview.com. Tradingview.com is again a simple website. So I am going to select again TCS, Tata Consultancy Services. Okay. After launching the site, it will look something, some scary thing will appear. Don't worry about this. Okay. So all you have to do is that once you can see these green and red lines, forget that. In the indicator, select one indicator known as super. Super, once you type super, you will have the super trend and super trend strategy. So select this super trend and also select super trend strategy. Remember this super trend and super trend strategy. How do you remember? Just type super in indicator. So once you select this, okay, once you select this, it will automatically tell you when to enter. It will automatically tell you when to enter and when to exit. Here you can see that it was telling when to enter. So you can enter here, my long entry. So it can enter, and if you want to exit, you can exit here. But this will automatically tell you when to enter, when to exit. It will have all algorithms. This is based on something known as the moving averages and everything. But this is an automatic indicator which will tell you when to enter, when to exit. Okay. So now is it a good time to enter TCS? The answer is yes, because it has given entry now. Okay. So this will make your life simple. So coming back, so we have done a fundamental analysis doing an MPTDS criteria. We are doing a valuation analysis seeing the profit and the stock price, and we have done a technical analysis using something known as the super trend indicator and strategy. So I have explained you everything for fundamental, valuation, and technical. Each one is 6 months course, but I have done a rough thing so that you can easily do and select a stock in 2 minutes. So doing a fundamental analysis take 2 minutes, valuation 1 minute, technical analysis 1 minute. So in less than 5 minutes, you can select a good stock and start investing right now. Okay, you don't have to ask anybody. Okay. So now coming back, now which sector, sir? There are so many companies. I've got so many MPTDS valid criteria. So there's something known as sectors in our market. Now what are the sectors? They are grouped. They are grouped into compartments. All the stocks are grouped into compartments. So we have 15 sectors. For example, there can be an energy sector, there can be a material sector, there can be an industry sector, consumer, healthcare sector, financial sector, IT sector, communication services, utilities, real estate sector. Like that, there are 15 sectors. So each MPTDS value stock, we take 2 stocks from each sector. So 15 sectors, 2 stocks will become 30 stocks, which is more than enough. You can build your own mutual fund without paying any expense ratio to the fund company. So 15 sectors, 2 stocks from each company. Each stock should fulfill MPTDS criteria. Okay, I'll give you an example. For example, banking, you can choose. These are not recommendations, these are examples. Banking, HDFC Bank, ICICI I can have. Automobiles, Maruti, MRF. Healthcare, Divi's Lab, Lalpath Lab. Logistics, VRL Delivery. Finance, Bajaj Finserv. Media, footwear, chemicals. So like this, I can select 2 stocks into 15 sectors, make my portfolio for long term and start investing without asking anybody. Okay. Then when to invest, I told you the technical analysis. Please remember the super trend and super trend strategy. Log into the trading view. Just put that strategy. It will automatically tell you when to buy, when not to buy. That is more important, when not to buy. Okay. Then how do you invest? So where should I start investing? So you have to open a Demat account either in Zerodha, Grow, Paytm Money, do a KYC, you add funds, then you can buy a stock automatically during the market hours, which is from 9:15 to 3:30 p.m. Okay, now the market is closed, you can't do anything. So it is very simple and very easy. You don't have to ask anybody. Don't give your money to anybody. That is more important. Okay. Now, how much should I invest? So it depends upon how much risk you can take. This is a fair division, but somebody can argue I am 55, I can invest 75. It is up to you. But younger the age group, the more you put it in stocks and lesser in bank FDs and government bonds. Okay, more in equity. As the age grows, you reduce your exposure to equities and shift your profits of equity to more secured or less risky debt funds or bonds. So that if you want money, then you can take it from it. Okay. So the calculation is 100 minus the age, which is a simple, but I have seen many 70 years who are investing more than 90%. Okay, so it is not a fixed rule. This is a rough rule. Okay, so that is how it goes. So in summary, open a brokerage account, decide which stocks to buy by doing a fundamental valuation and technical analysis, and decide how many shares to buy. That depends upon how much money you have. Choose the order type, market or limit. That is a technical one. Don't worry about that. Select a stock order means which broker you want to buy, and start building your portfolio right away, so that in long term you can have a excellent money for your older age group. Okay. So in the last, I would like you to request to join our group Financial Fitness, which is free. So if you want a free home loan and if you want a free car worth 25 lakhs, so immediately join the group. Thank you. Okay, so I'll stop sharing here. So any doubts you have, please ask me. Because I
Thank
have
you so
5
much,
more
sir.
minutes.
Thank you for such a brilliant presentation, and you have simplified the most dreadful the stock exchange market in a very simple way. And
Any
now
doubts,
questions?
madam?
Yeah. So any questions are most welcome.
Dr. Meenakshi, can we take a question answer session after the all
Sure,
three
ma'am.
topics?
Sure.
Okay.
All three sessions
Then
will.
I will
we
hand
have-
over to Dr.
yeah.
Ajay Kumar. Thank you.
So now may we welcome Dr. Ajoy, ma'am?
Yes, yes.
Yes. So I welcome Dr. Ajoy Kumar to share his wisdom on the topic exchange traded funds. Let me introduce sir. Sir is Dr. Ajoy Kumar. He is a pediatrician in Akshay Memorial Mother and Child Clinic since 1992, Hyderabad. He was a co-convener Finance Committee CIAP up to 2023, lead coordinator F3 Personal Finance Learning Group with 1,500 doctors, IAPs, PATs since 3 years. He was a treasurer in Pedicon 2010, chief organizing secretary Pedicon 2016, advisor Pedicon 2025, CIAP executive board member in 2010, 2015, and 2019. He was president TCB PATS and NNF State Telangana, working partner in Medi Associates and Doctors Incorporation firms. He is a teaching faculty for DNB students. Editor Board IP 2019, Founder Secretary Family Benefit Society IAP, Secretary CMIC, and Founder Secretary State Branch CMIC. Currently working for doctors to spread personal financial management literacy. So welcome, sir, welcome, and please empower us with your wisdom. Let me stop sharing my screen. Yeah. Over to you, sir.
Thank you, Dr. Meenakshi, madam, for introduction. Am I audible?
Yes,
Hello.
sir.
Yeah, thank you very much, Dr. Meenakshi, and thank you, Sangita, madam. Thank you, Anuradha, madam, and all the office bearers of Women's Pediatric Forum. Thank you, Dr. Hemabindu Singh, who is the founder and our Hyderabadi from Hyderabad, and Dr. Tripti, our co-speaker today, and all the others, ladies who have joined today, and my group members from PATS. It's a pleasure to come back again after 1 year and talk about some subject which we have started learning from past 4.5 years. And it is growing leaps and bounds. So some of the topics we have learned and trying to crystallize it, as Dr. Harish in his opening talk has given you such a good curtain raiser, simplifying it into a few points and for the selection of the stocks. I have been given a talk on exchange traded funds. So I try to demystify this particular name, exchange traded funds, and what exactly it means. If you give me a minute of sharing the screen for my PPT. Dr. Meenakshi, can you see my screen?
Yes, sir.
Yes, sir. Yes, sir.
Yeah.
Yes.
Thank you. So I'm indebted and grateful to an organization called WealthCon, which has refined me and taught me more knowledge about the personal finance management. And I have taken a small ideology of the WealthCon and displayed it, why we should learn and why we should not depend upon financial advisors or our chartered accountants or bankers or relatives to guide our financial management. It's all to tell you that we have to be self-reliant and self-confident. And the introduction, one of the office bearers also told it's in our decision making to help us develop financial independence and financial freedom, ultimate goal. So today's we have got 3 talks, talk selection already done by Dr. Harish, ETF by me. I'll try to make it as easy as possible, and gold investment by Dr. Tripti. Please remember, we are not SEBI registered, that is Security Exchange Board of India's registered advisors. We are only doctors with some enthusiasm and also interest in finance, which we have learned on our own by attending few courses and classes. So this lecture, don't take it as a recommendation. It's only for educative purposes. Well, I have to tell you good news that I have cleared my equity stock market certification from Indian Institute of Management, Bangalore. I finished a course on behavioral finance from IIT Kharagpur, and also National Stock Exchange accredited e-learn markets certification course on stock investing. So a little bit of knowledge in the drop in the vast ocean of finance I have developed, and I'll try to share with you in this brief few minutes. Well, all of us work so hard. We have studied so much, and the basic aim is to develop assets. Now, you know the types of assets we always try to accumulate, or at least develop: our physical assets, movable assets, financial assets, intangible assets. These are what we have already been filing in our income tax department, the fixed assets and the movable assets, inventory, etc., in our balance sheets, in our yearly returns. But I like to give you a further classification of financial assets, which is the talk of the town and the trending nowadays all over the world, including our profession. The assets in the financial assets, which are just now talked about by Dr. Harish as equity assets, that is stocks. I'm going to talk on the part of the equity and derivatives, is the most favorable assets which we have, because they are invisible. And because they are invisible, even though you are a crorepati, even though you are a billionaire or a millionaire, they are not visible to your neighbors or to the public. So you will have non-envious friends. The moment you have physical assets like land, plot, buildings, cars, etc., there is always a jealousy and envious comes. So there is a favorable wind going on in the accumulation of the financial assets because of the government's regulation and regulated bodies which have come into play in our country. And these are the 2 volatile and non-volatile assets which we are having in our armory to go about in investing. Among these 2, the non-volatile assets are fixed assets like debt funds, like fixed deposits, like PPF, etc. And volatile assets, that is what we are discussing today. All the 3 topics are volatile assets. That means the stock prices or the price of our asset will go up and down for a short period of time, but over a period of time, they are used long term. When we talk about long term, in the finance management, we usually say 7 years. And that is used for creating wealth, both for our goals and our retirement. So my topic today is exchange traded funds, short form of ETF. I advise you to go to the National Exchange website or government regulated website of the Stock Exchange of India, and you have a topic about all about exchange traded funds later on to gather more knowledge. And already been introduced as a lead coordinator. We have got 1,600 doctors every day. Messages are posted, learned, answered, questioned, and we are improving our knowledge day to day. it's a big opportunity if you just look at the macroeconomic of our country and the world. In India, the population which invest in the financial markets is just 2.5% in comparison to United States of America, which is almost 50%. China is 44%. Japan is 20%. So there's a huge opportunity waiting for all of us to exploit, use this, and develop our wealth. And let me tell you the latest news. June 24, it was a watershed month of mutual fund industry in India. The AUM means asset under management by all these funds houses hit 60 lakh crores for the first time in the history. And 10 years back, mind you, this AUM was 10 lakh crores only. So in ETF now, in a short time given to me, like Harish, I'm not so well versed to crystallize in a short way because it's an absolute new subject to all of us. I'll try to give you in various subtopics regarding exchange traded funds. Remember, what Dr. Harish about stock selection said is an active management of your investments. That means you have to go through the selection process, you have to assess, you have to analyze, you have to know when to buy, you should know when to exit, you should know when to hold and when to dilute it and make profits. Whereas exchange traded funds come under the category of passive funds. Now, what are passive funds? There is another category of a financial instrument known as index funds, and both come under the category of passive investing. The money which you actually invest reflect the already index present in the stock exchange indices like NSE or BSE. For brief, the topmost index is Nifty 50 or Sensex. You must have heard about that. We mimic or mirror those investment stocks and we invest in the exchange traded funds as an index fund or an exchange traded fund. So a brief differentiation. Passive funds aim for the return in line with the market, in line with the indices, whereas active funds, there is either you as an investor or your fund manager aims to beat the market. For example, I am today getting 15% returns to my investment. My fund manager will try to beat it above 15%. That is an active fund. But what is the difference? It is hands-on active trading. You have to keep monitoring it. And passive is just hands-off trading. The major difference is this slide. You have to spend, any investment has got a cost or the fees for management, right? So the passive funds, the fees is the least 0.5% of your asset under management. Also, the exchange traded funds or index funds are managed by asset management companies called AMCs. They are like our mutual fund management companies, but they charge 0.5% of the whole invested budget. Whereas active funds, because of the manager, the research analysts, the PhDs, the MBAs of finance, the infrastructure, they do research. So they charge you 1.5 to 2%. So the low investment strategy is linked to index. What you must have seen, 20 stocks, which is a portfolio suggested by Dr. Harish. If you have an investable fund of 1 lakh savings every month, you can invest 10,000 or 20,000 in 20 stocks, and that is 1 lakh every month. You start doing systemic investment program to invest in your portfolio to build up your wealth. Whereas in a passive fund, if you have a less than 1 lakh per month investable funds, you can opt for it. And also, if your risk profile as a personality is a less risk-taking person, you can go for this. So it is said that also we know that ETFs, exchange traded funds, are better than fixed deposits of the bank, better than post office schemes, and it is better than inflation beta among the FD and POs, because we know inflation is about 6 to 7% historically in India. So what are they? They are basically, ETF is a hybrid of a close-ended index fund and an open-ended index fund, and they have managed by an AP or an authorized participant. Passively, they manage funds. They don't do anything. They just track the index. If the index top 50 companies change, these people also change and mimic and clone the portfolio and the company in their product. Similarly, there is a branded name, no recommendation though, called Nifty Bees. This is the first ever Indian ETF which was opened in 2010. That means we are almost 20-25 years in the ETF, but now we are able to come to know about it information and doing that. And this invests Nifty Bees in the top 50 companies of National Stock Exchange of India as an index. And as per the market cap, the weighted average of each stock is done as per the market cap, which we have already discussed. So basically, suppose if you buy one ETF, it will have roughly 1/100th of the index and plus the cumulated dividend which is accrued in it time to time. We all know that Nifty 50, the top 50 are not constant 50 companies or rankers in the stock exchange, because they change according to the mood of the market, the trend of the investors, the institutes who want to invest, and the market macroeconomics. These top 50 keep changing. So every 6 months, the committee in the NSE decides who are the top 50 by their own criteria. The another index fund is Junior Bs or Nifty Next 50. That means the top 50 are the best companies of the India is not the only criteria. There are top 100, top 150 or top 200 companies are good companies, but the index has got a place only for 50, the Nifty 50. So we have got a Junior Bs called Nifty Next 50, and liquid Bs are the Bs which are actually bond market instruments where your money is available to you in a short call. So the ETF is divided into various types of indices it mimics. It can be a gold ETF, it can be a global equity ETF, it can be debt ETF, it can be equity India. But I will today try to tell you the information and make you aware of equity ETF. The key benefits for all of us is we can buy and sell this ETF through the brokerage account, and it's so easy to just order for buy every day and keep it in our account in a single transaction. How to invest? You have a broker's account opened, you choose what ETF you have to buy, and you sell it whenever you want to sell it through the stock exchange, quotes and prices available there. So ETF really offers the convenience and the efficiency of various assets and make them an attractive option for us. So basically, you should have a 3 account. Already Dr. Harish has said you should have a bank account. I would suggest keep a bank account with the money exclusively for the investment purposes. Let it be stocks, let it be gold, let it be ETF, let it be indices, but keep an account only for the investment, not for your kharcha of every day or budget for other expenses, and link it to the demat account through the depository participant. Now, most commonly in India, the top 3 or 4 brokers are Zerodha, Grow, Angel One, etc. The Zerodha broker, based in Bangalore from past 15 years, has reached the top position with almost more than 12 crores accounts, and Grow is following behind Zerodha, and it is the second largest broker account app, which is also based from Bangalore and also Singapore. So how do you enter the market and find out where they are available, these ETFs? Mostly don't go for the new fund offers in the primary market, because you don't know if that ETF have some price growth appreciation or not. Already available ETFs are quoted every day in the secondary market in the stock exchange, and you just go order it, and the exchange from the another buyer or another seller will be giving it to you, and your money gets settled through your broker's app. Now, I would definitely focus on these ETFs in these indices only, because as you see, the historically Nifty 50 index over a period of 30 years, actually it was opened in 1990 or 1992 during the Harshad Mehta scam, was base value was almost I think 1,000, and today we are having a Nifty which is almost 25,000 or something. So you see the graph which Dr. Harish says that prices should go up. There were a lot of volatility. There is like a ECG curve up and down, but overall the Nifty 50 has gained, and the average calculated by the financial experts by a formula called compounded annual growth rate is around 14 to 15%. So our investments, if we invest passively, just sit over it, don't do year-on-year monitoring, don't have to look again and again, don't have to sell and buy, worry about when to enter, when to exit. The Nifty 50 index will give you about 14 to 15%, almost low risk, almost with a low safety, high safety. So we have got a 50, as I told you. We have got a next 50, which is known as NSE 100 index. We have got Nifty next 50, which is known as Junior Bs, as the branded ETF, and etc., etc. So for a diversification of your investment, as Dr. Harish told you, large cap, mid cap, and small cap, we do have ETFs of large cap, which is Nifty 50, Nifty 100, and Nifty 150. And you have a mid cap of Nifty mid cap 150, that is small cap, and micro cap is also there. They are all based on the market capitalization. Now, before you start investing, I have these 5 questions which you have to answer. Why do you want to buy and invest? What do you want to buy? When you want to buy and sell? How to buy and how much to buy? Almost a couple of them has been discussed, but remember, every investment should have an exit date written on your diary. You want to buy today 1 lakh rupees of some financial investment, you should have a goal and why you are buying it. What is your goal? Is it for you to go abroad, or is it to buy equipment for your clinic or your hospital, or is it for the education of your child, or you want to do some post-graduation extra diploma course? So financially fix the goal and then buy, and then aim for it and go for it. So what to buy? In my talk today, my emphasis only on buy ETFs. When to buy, when to sell? There is no when to buy, when to sell here. When your goal is achieved, you sell it. When to buy? Whenever you start having investable fund with you, less than 1 lakh per month, you can go select one of these 3 indices like Nifty 50 or Nifty Junior Bs, and then Nifty mid cap or small cap, and start investing a little bit in it. And how to buy? We have already said, through our broker apps. The easiest broker apps are the best to find the ETFs like Zerodha or Grow. How much to buy? Your budget. Now, Nifty 50 recently, if you historically, which I told you, has reached almost 1,93,633 crores of asset under management in this particular investment fund. So there is a continuous rise from 1990, the Nifty 50 index, till 2024. And there is I just mentioned there, 80,000, the Sensex. That means this is BSE index called Sensex. It has reached 14% average it has given us. And there are folios, nothing but accounts. So if you see the Nifty next 50, it has got 2,859 crores as of June 30. And if you compare with other in assets like gold, Dr. Tripti will tell us, or stocks, Dr. Harish has said, overall average, it does give about 14% over a period of time. You can see the branded one, the Bs. What are Bs? It is nothing but exchange traded funds of a company called Nippon. I think it is owned by Reliance people. And today's rate, on that rate I made the talk, the Nifty 50 Bs is 270. And if you see all-time graph of this price, it is rising. There is a drop here. If you see, that drop is during the COVID time. And if you see the Nifty Next 50, which is also known as Junior Bs, it is also showing as a rise. Similarly, if you go to the other section, category of the fund called Mid Cap 150, the price is 1 unit of ETF will be 218, and it is also shown as a rise. Similarly, a different company from HDFC AMC, a small cap is showing a rise, and it is priced at 176. So price wise, they are affordable, and price trend wise, they are growing over a period of last many years, and it is giving a fairly good returns and easy to invest, easy to hold. So there is something called tracking error and also called expense ratios, which you are seeing here. What does it mean? It means for the ETF, which is managed by, I told you, AMC, asset management companies, their expenses are less because they don't have to pay the fund manager. Do you know the fund managers of mutual funds are paid salaries in per annum in crores, whereas there is no manager risk is needed here. So you just invest by SIP and during dip. Now, this is the strategy of investing during dip and SIP, and just relax. What is SIP? Systemic investment plan. In your app, you fix up, I want to invest 20,000 in Nifty 50 ETF every month hereafter. The moment I receive the salary or the moment I get my income, on 5th of every month, I want to buy 10,000 worth of Nifty 50 Bs or Nifty 50 Junior Bs. And what is the dip in between? When you're observing, you see a 10% drop or a 5% drop, which is known as dip buying. From its all-time high price, you accumulate because it cost averages over a period of years. If you're buying today for 100 rupees, there is a drop by 20% or 10%. You're buying the next Nifty 50 for 90 rupees. Like that, you keep on buying, so it gets averaged out. So dip buying and SIP buying gives you the best way of holding and creating wealth, better than most of the stock selection which you do. Excuse me. Yeah. So auto investment is what is we call as SIP. You don't have to worry about selections, price following, year on year monitoring, and it is ultra passive way of investment. That's why it is known as passive investment. You can either do a SIP or you can do lump sum, because the risk factor is very, very less, and there is no exit load like mutual funds comparison to the ETFs. So you are not burdened with when you want to go out or when you want to redeem, when you want to cash out for some purpose. You don't have to pay money to the fund managers or the fund houses. ETFs, this is the data from the National Stock Exchange I have picked up. Impressive growth over the past almost 5 to 10 years. 45% growth is happening in ETF industry. And indices funds. Mutual funds also make index funds. Even there the growth is. But I will try to show you what is the difference between an ETF and mutual funds also in the index fund. See, from almost 1,000 crores in 2012, the ETFs investments have gone to 4,11,000 crores in 2022. So it's a tremendous increase, 5 times over a period of last 2 years itself in ETF, in the investors of India, in the retail investors, not the institutional investors. Now, let's see what is index fund. Index fund, briefly, first introduced in the world of financial market in 1976, way back in United States of America by Bogle Vanguard company. And it was a passive investing. It was less risky, he said. So in India, it came in 2018. So in the name of Nifty 50, I just now told you all those things. But it is managed by mutual funds, these index funds. Whereas ETFs are displayed in National Stock Exchange website. So you can track it in a NSE or you can track it in BSE. The basic thing you must know that it does not beat the index, what do you call the rates. Suppose the index is at 10,000, your fund or your portfolio may not be more than 10,000, but there are chances because dividends are added there, expense ratio is less, there is no exit load, there is no maintenance of the fund, it gets slightly more. That's why we call it, it's have higher alpha than the mutual funds. So what are Bs? I already told you, it's managed by a company called Nippon Asset Management Company, benchmark exchange traded scheme. This is the most popular ETF in our markets today. Most of our doctors go in for this, Nifty Bs. And it is just one unit is 1/100 part of the Nifty index, 100 part of the Nifty 50 index, value-wise. And so the difference between mutual fund I've shown you here. Mutual funds are also actively managed. ETF is passive, but it is managed by mutual fund. They try to outperform the market, as you see in that small chart on the right upper corner. If you see the mutual fund, it gives 14.18, whereas if you see the Sensex, it is 13.68%. Not very much difference between the Sensex and the equity mutual fund. So there you are paying more to manage your funds. In ETF, you don't pay that much to manage your funds. So difference between ETF and index funds is this much. Stock exchange based fund houses are large fund houses, of course, and they are managed by them. They are linked to NAV. NAV is net asset value, which is displayed every day in the quotes of the ETF category. Whereas in the mutual fund, this is the major difference. The fund value or the mutual fund value is announced by the fund house at the end of the day. So suppose you want to sell it at 12 o'clock in the day. You don't know at what price you are selling. End of the day, the fund house will decide. Whereas if you are selling a ETF when you want to redeem or you want to cash out, you know exactly at what price you are selling your fund. So there is a real-time pricing there, though there is a fluctuation, whereas it is end of the day pricing in the mutual fund. Differences between, again, index fund and ETFs continues, but the best part is that it's a real time. It has got limit orders. It is possible. It's a stock exchange you can see every day. Rest of them in index fund by the mutual funds you can't see, and there is an exit load. So how to select ETF and index fund? Please remember these 5 criteria. Go for size of the fund house. As Dr. Harish Gopal said, 10,000 crores and above fund house having the management of the ETF. Go for it, larger the better. Trading volumes, if you see in the exchange website, the graph of the fund's price, there is on the bottom, there is a volume bar chart. If you see higher volume, people are buying the funds or selling the funds, that means that ETF is a good fund. And tracking error. Now, tracking error is some error wherein the index is telling it is 20,000, but your ETF is telling it is 19,998. Means that 2% difference could be due to some variable factors. The lesser the tracking error between your selection of ETF and the actual index is better. And expense ratio, lower the better. 0.05% is what is normally we look for. Now, passive funds are used, the ETFs. There is a concept called having a core portfolio and a satellite portfolio, right? Dr. Harish told you just a portfolio, but many of our doctors, friends, and investors have got a core portfolio of a long-term investment of the stocks or ETFs or gold or whatever it is. And there is a satellite portfolio of 20% of your budget in a changing stocks to make profits, probably on year monitoring or 6 months monitoring. So ETFs can be used in both core portfolio and satellite portfolio, and also completion of portfolio. A completed portfolio is 20 to 25 stocks, right? So you have got say 1 crore as your investable amount and you want to distribute among all the assets. You can also complete your portfolio with filling up of ETF. There is no selection risk or like in stocks or like in other asset in ETFs. It is already selected. Why look for a needle in a haystack when you can buy a haystack itself? That means you buy the whole index and there is no prediction risk. You don't have to predict which company is going to go up in the ranking in the index every year. We know every year this companies keep changing. The topmost company will become second. Like recently we saw there was a change in HDFC and Reliance as the top companies. The rank 1 and rank 2 went up, and last 2 companies totally vanished. Like Yes Bank vanished from the index and something else came in. So these things, prediction risk is almost over if you buy an ETF. So conclusion, ETFs are for diversification. It has got transparency. It has got clarity. It is convenient. It is flexible. It is low cost. Operation costs are so low. Management costs are low. It is liquid. Higher the volumes, more liquid is the ETF. And it is also tax efficient. If you sell the ETFs and dilute it within 1 year, after 1 lakh of your profits, you are applicable as a tax as a short-term capital gains, which is about, I think, 15%. And a long-term capital gains is after 1 year, after you finish the slab of 1 lakh, and it is about 15%. But if you don't sell, unrealized profit are not taxed even for 10 years. So you hardly pay any tax year on year. So with this, I conclude my talk on ETF. And if you want any more awareness on the finances, which I encourage you, kindly go through these references from which I have taken it. And these are the 2 YouTube channel IDs which we have got, where there 39 to 30, almost 65 webinars are recorded there, and you can kindly go through them to improve our day-to-day personal finance management. Thank you very much.
Thank you, sir. Thank you for such an excellent presentation. And you have explained this complicated topic in such a simple way. And we'll take the questions later on. Now it's time for our third and equally important topic, gold. Gold is an age-old asset of every woman. It is our pride. But is it okay to keep our gold locked inside the closet for a lifetime? What if we can invest all that gold and actually enhance its value? So our next session will make us to think about this option too. I welcome Dr. Tripti Mahatme ma'am to share her expert views on gold investment. She is a consultant pediatrician at Nasik, ex-assistant professor at Dr. Vasantrao Pawar Medical College, Nasik. She is also an IAP ALS instructor and personal finance enthusiast. Over to you, ma'am.
Thank you so much, Dr. Meenakshi. Wonderful sessions by Dr. Harisha Gopal sir and Dr. Ajay Kumar Gupta. And I must say that it's a wonderful feeling for me, and rather it's my privilege to be here on the platform of Women Pediatric Forum once again after 2 years for the webinar on finance. And my sincere thanks to Dr. Sangita Lodha Bafna ma'am, who is a chairperson of WPF and other WPF dignitaries, for giving me opportunity to share my knowledge for the education purpose. So before we start, let us have this small pretest which contains just one question. It's not MCQ, it's an open-ended question. So I will read out the question and you have 10 seconds. Please type your answers in the chat box. So given a corpus of 10 lakhs rupees for investment in gold for long term, which type of gold investment you will opt for? Okay, so you can keep on typing in the chat box. Let us move ahead. So basic purpose of my talk is to make you aware about various avenues of gold investment and also sensitize about investment in gold. So first question, why should we really invest in gold? Now, whenever we invest, there are three criteria, that is safety, liquidity, and profitable returns. And all these criteria are expected to meet by investment in gold. There are some important points. So first is historical stability. Gold has withstood many economical downturns, so it is considered as a safe haven during the time of crisis. When it comes to any investment, the basic principle of investment is diversification. And gold is an excellent diversification tool. It mitigates the risk like extreme market volatility. It's an excellent hedge against inflation, not only against inflation, but any kind of economical instabilities, currency fluctuations, or war. Gold tries to retain its value. It has got a global acceptance, so it is a universally accepted asset. And it's needless to say about the cultural significance of the gold. It is a symbol of worth and prosperity, and the emotional value of gold has created demands across generations in India. And the next important, so when it comes to investment, our target is returns. So this graph shows historical annual returns of gold from 1980 to 2020, and research has shown that, and even we have seen in previous presentation, that gold has given inflation beating returns. You can see the chart which is given over there. So in 1947, the value of gold for 10 grams was 89 rupees. It has appreciated to 48,000 rupees in 2021, and now it has boomed to 75,000 rupees in 2024 for 10 grams. So these are various reasons why gold should be there in your investment basket. Now, once we had decided to invest in gold, so where and how should we invest? So these are the various avenues of gold investment. First is traditional, which every one of us is aware of. We put our money in physical gold like buying jewelry, coins, bars, etc. Now here, let us give some food for thought again. So question is whether jewelry is an investment option for gold. And the answer here is no, because we never sell our jewelry and generate revenue out of it. So next what? Over the period of years, investment in gold has evolved. And now, as Dr. Meenakshi has already said, that gold doesn't just deserve its place in lockers or home, but we can generate revenue out of investing gold in various avenues. So which are these modern avenues? We have electronic gold like gold ETF, exchange traded funds, gold mutual funds. We have option of paper gold like sovereign gold bonds. And then we have digital gold, gold future and option contract. The last one is traded by derivative traders in stock exchange. So I will be not talking on it. We will concentrate on first four. So initially, I will give brief idea about these four avenues, and then we will compare between them to find out which is better option for optimum return. So let us first start with gold ETF. As Dr. Ajay Kumar sir has already told, it's like any stock ETF. It is traded on stock exchange just like shares. It is similar to buying an equivalent sum of gold, but without the hassle of storing the physical gold. We can invest very minimal amount like ranging from 60 to 100 rupees to invest in 1 unit. This is ideal for short-term trading and also for investment. It has a good liquidity. So what do we mean by liquidity? The asset is very easy to buy and sell. The only mandatory thing to buy gold ETF is having demat account. It has also collateral benefit of pledging, that is taking loan against ETF, but this I'll not talk about. It is used by margin traders in the stock exchange. We will talk more about other advantages of gold ETF over physical gold. Next, so these are some top gold ETFs in India. So look at the returns. There are 14% returns over last 5 years. Please understand, these are not my recommendations. These are just for example. Next is gold mutual fund. So this is like any other mutual fund. When we put our money in the fund, the manager of the fund invests it primarily into gold ETF again, and some of the portion will go to gold securities and gold mining companies. It again has a good liquidity. The necessity is open an account in mutual fund platform. We can either invest lump sum amount, or even we can do systemic investment plan. Sir has already told that investing fixed amount monthly. The advantage of systemic investment plan is that it averages the cost of buying over the period of years. The next is sovereign gold bonds. These are periodically released by Reserve Bank of India on behalf of Government of India. The returns are guaranteed by Government of India. These are available for purchase through leading public and private sector banks, post office, and even stock exchanges. I will be talking about SGBs later in detail. The next is digital gold. So everyone must be aware that there are many digital gold platforms which are available for buying and selling gold on your mobiles. Here, the investment company buys an equivalent amount of gold on our behalf and stores it in secure vaults. These are three major players of digital gold in India. The disadvantage of digital gold is that there are certain charges applicable for buying and selling. So there will be GSTs, there will be transaction charges, management charges, service charges, delivery charges, etc. The next is gold monetization scheme. This is not gold investment scheme. This few lines I have put just to sensitize you that if we are having physical gold in purse, then we can generate revenue out of it by depositing that gold in certain banks. So Government of India has introduced this scheme in 2015, and by depositing that gold in banks, we will generate annual interest of 2.25 to 2.5%. So after having brief idea about these various avenues, now our investment decision is based upon various factors such as risk. Risk means how much is the risk-taking capacity of the investor, as well as how much is the risk there in the asset. What is our investment horizon? What are the returns? What is the cost of maintenance of the avenues? How much is the liquidity, availability, and the taxation rules? So depending on this, I have tried to compare these four assets of gold investment in this table. So there is comparison between physical gold, gold ETF, gold funds, and digital gold. So first point is storage. We all know physical gold we have to possess with you in physical format, either at home or in the locker. So there lies a risk of theft and burglary. Electronic gold, that is gold ETF and gold funds, are stored in demat account. So there is no risk of theft and burglary. It is safe to store. Digital gold in India till now lacks certain regulatory oversights. We need to rely on the platform reliability where we invest in the digital gold. So there is some counterparty risk. Coming to the regulations, when we buy physical gold, we have to buy gold which is hallmarked by brand. When it comes to gold ETF and gold funds, these are regulated by SEBI, that is Security Exchange Board of India, which is like guardian of Indian stock market. Coming to digital gold, there are no direct regulations by RBI or SEBI. They are expected to follow certain regulations put on them by RBI and SEBI. So again, some risk of investment is there in digital gold. Now the next very important point. What about the additional charges? When we go to the jeweler's shop to buy jewelry or any coin or anything, first charges which will be applicable are design charges or making charges, which will start from 10%. It may rise to 20%, 25%, 30% depending on the design we choose. Then there will be GST of 3%. If we want to put it in locker, there will be insurance and storage charges of 3% to 4%. So if we want to buy a gold value of 1 lakh, we actually land up paying more, say 1,20,000, 1,25,000. When it comes to gold ETF, there are no making charges, there are no GSTs, there are no storage charges. The only cost which lies is 0.5 to 1% annually, which includes expense ratio, demat account charges, and brokerages. Same with the gold fund. The total cost of maintenance is 0.6 to 1.2%, inclusive of management of fund. Coming to digital gold, again here GST of 3% is applicable and there are spread charges of 6%. Now, what do we mean by spread charges? It means that when we buy, we land up paying more than the prevailing price, and when we sell, we get less. So physical gold and digital gold, both spread charges are applicable to both. Next point is, what about redemption? So when we sell physical gold, again we get lower resale value because of the breaking charges and the taxes. It is inconvenient due to possible impurities and the requirement of origination and purity certificates. ETF and gold funds are very liquid. We can redeem during market hours. And whatever capital appreciation is there, we will get into our account. Only gold funds, they have exit load of 0.5 to 2%. So while choosing investment in fund, choose a fund which has less exit load. Coming to digital gold, there are variable policies depending on the agencies. So some agencies, they don't have any restrictions on the holding period. Some agencies will ask you to either convert your gold into physical gold, which you will have to take the delivery, or sell the gold and convert it into cash. Some agencies might restrict the redemption during market volatilities. So there are variable policies about digital gold. Now, next and last, very important, is taxation. Understand this carefully. If the holding period of gold is less than 3 years, STCG is applicable, that is short-term capital gain tax. And if the holding period is more than 3 years, long-term capital gain tax is applicable. So for physical gold, STCG, if we sell the gold less than 3 years, then it will be as per our tax slab. If we sell it after 3 years, then we will get tax implication is 20% post indexation. What do we mean by indexation? The cost of the asset is adjusted as per the inflation so that the tax applicable amount will go down. So this is advantageous for consumers like us. Coming to ETF and gold funds. So again here, as per there are some rules which are changed. So ETF and fund which were bought before 1st April 2023, the STCG will be applicable as per the tax slabs. The LTCG will be 20% with indexation. But ETFs and gold funds which are bought after 31st March 2023 will incur STCG at slab rate irrespective of the holding period. Digital gold, if period is less than 3 years, then STCG as per tax slab and LTCG 20% post indexation. So these are certain important pros and cons of gold avenues one over other. Now coming to the last part, that is sovereign gold bonds. I have purposefully kept this part as last because of its unique advantages. So this is the safest way to buy digital gold. This is issued by RBI on behalf of Government of India. Now who can invest in sovereign gold bonds? Any resident of India, any individual, HUF, trust, universities and charitable institutions can invest in SGBs. Minors can invest through their guardians. Now about the specific points of SGBs. First advantage is we get interest rate of 2.5% per annum, which is payable half yearly to our account. No other gold investment avenues will give us this interest rate. So this is unique advantage of SGB. The minimum investment which we can do is unit of 1 gram. The maximum investment which we can do, any individual can invest up to 4 kilograms, HUF 4 kilograms, trust and similar entities 20 kilograms per fiscal year. What is the maturity and lock-in period of SGB? The maturity is 8 years with exit option available 5th years onward. Who will be issuing and how RBI will be issuing it? It will be issued periodically, maybe quarterly throughout the year. The buying window will remain open for 5 days at a time. We need to invest in SGBs during this buying window, we can invest through certain public and private banks, post offices, and even through stock exchanges. Are there additional charges of buying or redemption? No, there are no additional charges. So there is no GST, no making, nothing, no charges are applicable for buying and for redemption also. What the investor will get after redemption? Their assured market value of gold at the time of maturity. So how much we get? We get regular interest payout 2.5% per annum plus potential capital appreciation with tax exemption if we redeem them after 8 years or even after 5 years. So once the lock-in period is over. What is the other advantage of HGB? We can use it as a collateral security for availing loan. Now the last part, coming to the taxes on HGB. How the interest is taxed? It is taxable under the head of income from other sources and will be added to our total income for the year. The capital gain, I already told that if we redeem after 8 years or even after 5 years, there is exemption from the tax. So whatever capital appreciation is there, you will get as it is in your account. If they are redeemed before maturity, less than 3 years, short-term capital gain tax is applicable as per the tax slab, and more than 3 years, long-term capital gain, that is 20% post-indexation. So with this slide, I'll conclude my talk. There is no one-size-fits-for-all solution. Choose gold investment to suit you. As per rule, there is no rule as such, but what experts say that out of your total corpus, 10 to 15% or even 20% you can invest for gold. If you want to invest in gold for long term, for more than 5 years, 7 years, 8 years, then sovereign gold bonds are the most suitable choice. If you want to invest for short term, less than 3 years or 5 years, gold ETFs and gold mutual funds are more suitable. For investment, physical gold and digital golds are not suitable. So with this, I will conclude my session. Thank you so much.
Thank you, Dr. Tripti ma'am. Thank you so much for this wonderful session. Now, I don't think we have to worry about our gold anymore. So now the house is open for the questions. From the chat section, I have only 1 to 2 questions. One is, which is better, yearly investment or fixed investment?
If it is for me, I would say because it is exchange traded funds, I've already mentioned either you can do a lump sum or you can do a systemic investment planning. But other investment avenues like gold or probably stocks, a systemic investment plan is better because you don't have the risk of losing money if you do lump sum. Whereas you can watch that it is falling down and then you can hold the next investment. Dr. Harish.
Yeah.
So, Dr. Harish, you want to say anything? And sir, if out of these 3 topics, we have seen all these investment plans. So if we have to choose one of them, either stocks or exchange traded funds or gold investment, is there anything which you can decide upon?
I think a very good question. But most of the organizations where I've attended and books I've read, there is a mnemonic called GRED. Please remember GRED, which means greed or greed. G stands for gold, R stands for real estate, E stands for equity or shares or stocks, D stands for debts. So you must invest for diversification, safety, growth, and also risk mitigation. These 4 assets. The basic thing is financial markets, capital markets is the important source of assets to be invested by professionals like us because of the regulations, because of the government controls, and also because of the returns it gives over a period of time. Among these 3 or 4 assets which we just talked about, we didn't talk about real estate because it's such a big topic. Gold, debt, and equity. In equity, we said about stocks and ETF. Equity gives the highest returns. even if it is self-managed, manager managed, portfolio managed by professionals, it gives the highest possible returns, unlimited, sky's the limit. People talk about 20%, all for the greed of more than 25%. Achieve yourself 15% through ETF, mutual funds, maybe up to 20-25%. Gold, as Dr. Dipti has mentioned, overall it has given 8 to 10%. And the flavor of the season in gold is, as she has mentioned, sovereign gold bond. It is issued by Reserve Bank of India. It is giving 2.5% interest rate, and it has got a capital appreciation. Those who finished buying jewelry for themselves, the next option is, I think, in my mind, and most of our experts say, is sovereign gold bond. And it's a primarily issued every year 6 times by RBI or 5 times, as Dr. Tripti has said. And also it is available in secondary market. Sometimes you can buy in discounts. Like I am a 10 bonds holder. I am in need of money. I want to redeem it earlier than 5 years. If I give it to RBI, it gives me less money or may not take back. So I will put up for sale in a secondary market. So I will sell at discount. If you are a buyer, Dr. Meenakshi, she will hunt for a discount gold bond, and 100 rupees gold bond, she can buy it at 80 rupees also. Though it will have all those terms and conditions of 5 years lock-in, 7 years redemption, 2.5% interest will come to her, appreciation of the gold value will come to her. So SGB in gold, ETF in equity, personal stocks, MPTDS, MD Sport in stocks. Please remember, if you have investable value more than 1 lakh, go for stocks. Less than 1 lakh per month, go for ETF. Long term, hedge against inflation, gold, as Dr. Tripti has said.
Sir,
Okay.
I just want to know about your idea about SWP, systemic withdrawal of your investment, like this. Something.
Systemic withdrawal plan, madam?
Yeah, yeah. And second question is, what is the best age to invest in this stock market? These 2 questions.
Second question, first answer. Earlier the better.
Yeah.
Youngest age, make your newborn grandson to become a demat account holder. There is no restrictions to open a demat account age-wise, and start investing. Compounding effect, the 7th wonder of the world, as Einstein is attributed to, said, will compound the longer you are invested and investing tenure. Harish sir, you want to say about SWP?
I think that any age is better, sir.
Okay.
You should just start investing. That's all. And what was the first question, madam?
I
SWP.
want to know just about SWP.
Madam, you have accumulated a very good corpus, like around 1 crore. At the age you started investing, for example, at 25 years, and at 65 years you have made 1 crore. Now you want a daily money. Now you don't want to take away that money. You want to keep that money in equity, but you still want money for your daily expenses. So there is a rule that if you take 4 to 6% per month out of that corpus, you will still meet your monthly expenses plus make your money grow at the same rate. So you're preserving your original amount plus getting your monthly expenses by withdrawing 4 to 6% from the accumulated corpus. So you go to your mutual fund, there's an option known as SWP. Then from there, you select 4 to 6%. Then every month it comes for your personal expenses. That is a systemic withdrawal plan. That is only after you accumulated enough money, not at the starting.
Yes, yes.
Okay.
So
Thank
for
you.
you,
And-
it is 1 crore. If suppose it is 1 crore is in your account for
4 to
this,
6 lakhs.
then you must think for that, right?
Also, I would just want to add that never buy physical jewelry, just buy imitation jewelry. It is more good looking than physical jewelry, and invest everything in SGBs. And we can get SGBs at right now secondary SGBs are minus 15% discount. So please grab that opportunity to buy SGBs and buy imitation jewelry. It is available for less than 1,000 rupees and flaunt each design, and you will not be bored at a new design at every function. Thank you.
So from where to buy these SGBs right now on the steps?
Madam, for a secondary SGBs can be brought from the market, madam, from the demat account. So
Okay.
there's a section known as how to buy SGBs at a discount, which I can take sometime later. But you can buy it in the secondary market anytime.
Okay.
Okay.
I would add here as a message, key message to all of us here. Open a demat account. If all of you are having, fantastic. But 100% of you should have a demat account. Number one. Number two, make a portfolio of investment of stocks. Equity is the priority. Gold is there, real estate is there, debt funds are there, but equity is very, very important. That's the only wealth creation and wealth safety for the financial freedom and financial independence after your retirement for a long term. And you are allowed to open many demats. It's not that there is a rule you should have only one demat account. You can have as many demats, and all family members should have demat accounts. Even a junior or a minor in your family should have a demat account. So if you have investable funds, which you don't want to invest only in your portfolio, you can always share it with your family member's demat account and build up his portfolio or her portfolio also.
And what about these arbitrage funds? Are they of use for our age?
Madam, arbitrage funds, suppose they are low risk equity funds, they'll give you around 6 to 7% of your returns. If you want to invest something like a fixed deposit, because of the tax benefit, you can invest in arbitrage funds. What they do is they buy assets which are high and sell it low. See, they capitalize on the price difference. They are safe and they are better than debt mutual funds for a shorter duration.
Because just I'm asking this question, my fund manager, we are investing so my fund manager invested in arbitrage and now shifting gradually to the this equity fund.
Madam, word of caution, never give your money to your fund manager because they invest in regular funds and not direct funds. They are taking 2% of your SIP every month. So please tell them change your funds to direct plans, not commission plans or regular plans. Okay, then you will save crores of rupees.
Okay.
Okay, it's very easy to invest in mutual fund.
So
Okay,
you have to remember a mnemonic again there called DGO, Direct Fund and Growth Fund and Open Fund. All mutual funds should be having this particular criteria before you start investing. Regular funds are commission distributed by the distributor or the financial advisors or the banks. A direct fund is on the website of the fund house or on the Association of Mutual Funds of India's website. So your commission you don't give to anybody intermediary. So remember DGO.
So we have to buy it ourselves. I like growth and dividend. I understood along with a time that we should take always growth, not the dividends, because once they give dividend, the value goes down. But yeah, definitely we are not doing it ourselves. We need to understand little bit. We understand what is equity, what is that. So how to do it self? Just buy and maintain.
Madam, mutual funds is a separate topic where we can easily identify. But simple, madam, just select direct funds, just see the return, see the expense ratio, and just select growth option. Okay, so never select regular plans. Immediately close the regular plans and shift to direct plans. And the last word for closing, please close all your LIC policies. Please
Yes,
and
sir.
please, everybody have your LIC policies. Immediately run to the office tomorrow and close. They are giving only 4 to 5% returns, and you will be eating, they are eating away your money. The company is growing, you are not growing. Please close your LIC policy. ULIP plans, child plans, all are waste plans. Please close all of this. Directly do mutual fund investing or stock investing, and you can build wonderful money for your children. There's nothing like a child plan. Don't invest in Sukanya Samriddhi plan. They're all, whenever they tell you invest in a girl plan or a boy plan, those are all fake plans. Okay, thank you.
Thank you so much, sir. Yeah, definitely. I always joke regarding the LICs when they ask me to buy a LIC. I say, you will give me benefit if I die. So I don't want to buy.
No, even money back policy doesn't give you returns, madam.
Yes, yes, money
Endowment
back is
policies don't
useless.
give you returns.
Yes, yes, that they try to sell, but I always say that is useless. You will give some money and then that will be taken chunk from our money only.
Yeah.
So thank you so much.
I think Dr. Himabindu want to ask something, and after that, Dr. Meenakshi, you take 2 questions, and then we will stop the session. Over to Dr. Himabindu, ma'am. Please, you ask your question. And Meenakshi, next only 2 questions, next 2 questions, okay?
Okay, ma'am, sure.
From the chat box.
Thank you, Dr. Sangita. Very wonderful session, need of the day. And I really congratulate my colleagues from Hyderabad, Dr. Ajay Kumar, Dr. Harish from our own. They are really so wonderfully doing this for the whole IAP. And Tripti's joined them. Very, very much needed for the Women's Pediatric Forum. Good for discussions. My question, Dr. Ajay ji, is, for the basic, I think Harish also told a lot of things. Basically, how to daringly, to go start this whole process, something for very simple for the woman, what they can do initially.
Yeah.
So,
Not being an advisor,
Initially,
sir, you can open up, and then I'll add a last sentence.
madam, you can open a Demat account, start investing in Nifty Bs and Junior Bs. Finished. You have a wonderful plan.
Yeah. Same thing I want to add. Have a Demat account. Just click on the buy of Nifty Bs and Junior Bs. And if you have little more money, go for mid cap and small cap Bs. Bs are why we are recommending means, or why we are favorable means, volumes are big, liquidity is good. And it is the oldest exchange traded funds of India. Almost 2001 it came in the market.
And
So
cheaper also.
yeah, okay.
close your eyes, start investing in Nifty Bs, Junior Bs, and mid Bs, mid 150 Bs or mid 100 Bs.
And at the same time, I would like to add, you can diversify some amount to gold Bs also. So gold ETFs.
Well, I would say SGB is better than ETF and
Yeah,
a gold
definitely.
Bs. My
For
opinion.
long term, yes. For
Personal.
long term SGP,
Yeah.
for short term, gold Bs.
If you open your Demat account after say 6 months or 1 year with this particular instruments in your portfolio, you will see the return, which is really heartening. They will be all in green color. They won't be in red color giving you minus returns. So that's the simplest you can do.
Sir, the most important thing is after you invest, delete the app. Don't see every day.
Okay.
Sir, someone has asked any formalities when a minor who owns a Demat account becomes a major?
So minors cannot hold, madam, because they need a PAN card for opening a Demat account.
See, the PAN card is available for a newborn also, but there will be a guardian. It will be opened in the name of the guardian.
Sure,
You can do HUF account, madam. That is a better way to save tax and open a Demat account instead of opening a single Demat account.
Which bank to prefer for the Demat account? There are so many banks offering.
Are not related, madam. With Demat account, you don't require. You can see Demat account is by a company. You can link any bank account with a UPI or a net banking. There's nothing like you need to have a bank for opening a demat account. Any bank can do it.
My advice was have a separate account so that all your funds are transferred there, and from there you do the investments and the sales and buys, because you will have a better IT filing when it comes end of the day, and you can always keep an eye on your budget of investment and sales.
And so someone has asked about NPS pension scheme.
It's a different topic, madam, not
Yeah.
topic of the day.
Now we can invest in NPS, but again it's an equity fund where the government is managing to a fund manager. You don't require that if you're investing in a equity stocks or a equity mutual fund.
Dr. Deepa Janardhan was asking some question. Dr. Deepa Janardhan, are you there? You can ask your question, and then I think we will stop the session. Dr. Deepa, are you there?
Ma'am, no, I only asked that minor demat account question.
Okay.
And that's answered. Thank you.
So
It was
now-
very nice, ma'am.
Just one more question.
Thanks, sir.
Can I ask one more question?
Yeah.
Sir, as you are saying regarding,
Please
I'm just
remember,
asking.
all the financial textbooks and syllabuses and the experts say women are better managers of money than men. So please do not consider as that you don't manage money better than men, because they don't change their minds of investment so easily, especially selling point of view. If you buy an investment, you keep it for long to grow. Let the investment grow and compound, and then create a better corpus and a wealth on it. So it is proven scientifically. I'm not just telling just to please today's forum, but women are better manager than men in the finances.
I second this, sir.
Dr. Ajay, thank you. And I know Indra madam takes really, I endorse that. Dr. Ajay, thank you.
Yeah, she is listening by the side, and she thanks you for that response.
Dr. Meenakshi, now you ask Dr. Kalpana for vote of thanks.
Yes, ma'am. So thank you to all the eminent speakers to enlighten us with the pearls of financial wisdom. And now I think we can proudly give some rest to our fathers, husbands, brothers, and we can take the stakes in our own hands.
Yes.
And now I request Dr. Kalpana for the vote of thanks.
Unmute yourself, Dr. Kalpana. Dr. Kalpana, unmute yourself.
Madam,
Hello,
I'm
Pallavi,
also
unmute her.
meeting is attended by a house full of 100 people.
Actually,
Yes, sir.
actually, there were complaints in my WhatsApp that beyond 100 they could not join the group.
No, sir, they have shared a YouTube link.
Yeah, they didn't know.
I will share the link also, recorded link. Dr. Kalpana, please you unmute yourself and then start vote of thanks.
Ma'am, permission is already been given.
Yeah. Can you unmute her? Because I think...
Yeah, I have sent her request to unmute.
Okay. Hello, Dr. Kalpana. Dr. Kalpana. Can you unmute herself? Miss Pallavi, can you unmute her?
No, ma'am, I can send a request, but she is not accepting.
Unmute, Kalpana.
Oh.
Unmute yourself.
No, she's taking help of someone, I think.
Yeah,
we will wait because we want to respect each and every speaker, moderator, and the person who is giving vote of thanks, I think. We will wait 30 seconds. Oh. I think, Dr. Meenakshi, you have to give vote of thanks, and we will just apologize for the inconvenience, and I will just request you to give vote of thanks.
I thank you from the bottom of my heart to all the three speakers who have shared their expert views regarding the topic, which is most unknown to us as doctors and more so as females. I thank from the bottom of my heart Dr. Sangita ma'am to organize this very important webinar. I also thank Dr. Hema Bindu ma'am as a chairperson of WPF, Dr. Anuradha Sanidhya, Secretary WPF, our Vice Chairman, Dr. Elizabeth, Dr. Srilekha ma'am, and Dr. Narmada Ashok ma'am, the Treasurer WPF. So hats off to this WPF team who has already received a lot of accolades for this appreciable work. Thank you so much.
Okay. So see you all for the next webinar.
Dr. Kalpana is trying to unmute herself. She's not able to.
Yeah, Dr. Anuradha, please announce for the next webinar, which we are going to take on 25th of this month. And then we will stop the session. And Pallavi, you can stop after the announcement.
Yes, ma'am.
Yeah, our next session of WPF will be on 25th of this month. That will be tete-a-tete episode, 5th by Dr. Elizabeth ma'am, who is expert in nutrition. And don't forget to join the session. And we'll give you the details very soon in day or two about the session. Please keep your cameras on for the group photo. Everyone, cameras on. Hello. Smile, please.
Okay. Thank you.
Thank you, each one of you, for joining us. Thank you
Thank you.
very much.
Thank you very